Welcome back to The Explainer. I am so thrilled to have you here today because we're tackling a subject that impacts literally every single person trying to build wealth. There's a recurring motif in finance, and it's a harsh truth. It's not just about what you make, it is all about what you keep. You can have the absolute best stock picks, the most secure bonds, and a brilliant real estate portfolio, but if you don't understand how the government is taxing those assets, you're just leaving money on the table. So today, we're decoding Indian investment taxes directly from the latest guidelines.
Seriously, I want you to ask yourself, how much of your returns are you actually losing to taxes? We obsess over finding that one asset that gives an extra percent or two in returns, but then we just completely ignore the 10 to 20% we're needlessly bleeding out to inefficient tax planning. The stakes here are incredibly high. The tax maze is complex, for sure, but we're going to navigate it together so you can start protecting your wealth immediately. Okay, here is our roadmap for today. We're going to hit market investments, safe havens and hard assets, taxing pensions and life insurance, post office saving schemes, and finally, those crucial blind spots and regimes. Let's get right into it. Section 1. Market investments, equity, and debt.
For equities and equity mutual funds, there's a critical dichotomy you've got to understand, and it all revolves around that 12-month mark. If you hold an equity asset for 12 months or less, bam, you're dealing with short-term capital gains, and the government takes a hefty 20% flat tax on that. But if you just have the patience to hold that asset for more than 12 months, you cross over into long-term capital gains territory.
And that's where things get really interesting, because your tax rate drops significantly to 12.5%. That is your flat tax rate for long-term capital gains and equities. Patience literally pays off by slashing your tax burden. But wait, it gets even better. The first 1.25 lakh rupees of your long-term equity gains per financial year are completely exempt from tax. Completely. Zero. Zip. This means if you strategically book your long-term profits up to this limit every single year, you're literally pulling tax-free wealth right out of the equity markets. Now let's flip the coin to debt mutual funds, because the rules here have changed drastically. For debt funds, there is absolutely no long-term benefit anymore. Doesn't matter how long you hold them, they are treated as short-term assets. Everything you earn in capital gains here is taxed straight at your marginal income tax slab rate. Oh, and no indexation benefits to adjust for inflation either. If you're in the 30% tax bracket, you are paying 30% on these gains, period. Just a quick note for the high net worth folks utilizing alternative investment funds, or AIFs. Taxation here really hinges on the fund's SEBI category. Category 1 and 2 AIFs have what's called pass-through status, meaning the fund doesn't pay the tax, that liability is passed right through to you, and you pay based on your income slab or capital gains rates. Category 3 funds, though, they don't have this status. The fund itself pays the tax internally at the maximum marginal rate before distributing the net earnings to you. Moving right along to Section 2, safe havens and hard assets. All right, let's talk about the harsh reality for conservative investors. The interest you earn on fixed deposits and standard bonds, it is fully taxable at your personal income tax slab rate, added straight to your regular income. Plus, if you earn more than 5,000 rupees in interest in a financial year, the bank is going to automatically skim a 10% TDS right off the top. Unless you're investing in specific government-issued tax-free bonds, the tax man is definitely taking a cut.
Real estate is where things get really fascinating right now. The magic holding period to transition from short-term to long-term is 24 months. Sell before that and it's taxed at your slab rate. But current-day rules dictate that if you hold past 24 months, your gains are taxed at a flat 12.5% without any indexation benefits. However, there's a huge grandfathering clause. If you acquired the property before July 23, 2024, residents in HUFs might still have the option to pay 20% with indexation benefits. You literally have to run the math both ways to see what saves you more cash.
Okay, Section 3, taxing pensions and life insurance. The rules for pensions can feel like a total labyrinth, but they basically split down the line of commuted versus uncommuted. Uncommuted, which is your regular monthly pension payout, is always fully taxable as regular salary income, no exceptions. But for commuted pensions, meaning you take a lump sum up front, it gets specific. Government employee, that lump sum is 100% tax exempt. Private sector? Well, your exemption depends on your gratuity status. If you get gratuity, a third of the lump sum is exempt. If you don't, half is exempt.
For the National Pension System, the NPS, the rule at retirement is incredibly strict. You are allowed to withdraw up to 60% of your corpus as a lump sum. and that slice is beautifully tax-free, but you are forced by law to use the remaining 40% to purchase an annuity. And the payouts from that annuity, yep, they are fully taxable at your standard slab rates.
Now let's talk life insurance. Historically, life insurance maturity payouts were completely tax-free. But for traditional policies issued after April 2023, the crucial number to remember is 5 lakh rupees. If your total aggregate annual premium across policies exceeds 5 lakh, your maturity payouts become fully taxable.
ULIPs have a very similar trap, but at a much lower threshold. For ULIPs issued after February 2021, the limit is just 2.5 lakh in annual premiums. Stay under that, and your maturity is tax-free. Cross it, suddenly your insurance gains are stripped of their tax-free status and are taxed exactly like equity mutual funds, meaning you face that 12.5% long-term or 20% short-term capital gains tax.
Next up, Section 4, Post Office Saving Schemes.
We all love the post office for safety and guaranteed returns, but honestly, it can be a complete maze of contradictory tax rules. For example, the Sukanya Samriddhi Yojana is the gold standard. It gets ADC deductions, and the interest and maturity are completely tax-free. But on the flip side, the post office monthly income scheme offers absolutely zero ADC benefits, and the interest is fully taxable. Then you have the National Savings Certificate, where you get an ADC deduction, and while the interest is technically taxable, it's deemed reinvested, so it qualifies for fresh ADC deductions until that final year. You really have to evaluate these scheme by scheme.
And finally, Section 5, Crucial Blind Spots and Regimes.
First off, watch out for hidden TDS thresholds. The government aggregates your data across institutions. If your combined annual interest income across the Senior Citizen Savings Scheme, bank FDs, and post office time deposits crosses 40,000 rupees or 50,000 for seniors, an automatic 10% TDS kicks in. You can't just spread money across different banks to hide it. They track it cumulatively. And here is the absolute wait-a-minute realization. Section 80C deductions are only available under the old tax regime. We just spent all this time talking about life insurance premiums and post office deposits giving you 80C benefits. But if you opt for the new tax regime to get those lower slab rates, all of those 80C investments become absolutely useless for tax-saving purposes. Which leads me directly to our final thought today. Are your current investments perfectly aligned with your chosen tax regime? Because it's no longer enough to just invest blindly in good assets. You actually have to match your portfolio structure with the tax regime you plan to file under. Go review your portfolio today, run the numbers under both the old and new regimes, and make sure you're keeping as much of your hard-earned money as legally possible. Thanks for hanging out with me on this explainer, and I'll catch you next time.